The financial system didn't wobble, it detonated overnight. While most people were asleep, markets looked calm, screens stayed green, and nothing appeared broken. Yet behind that calm, a single executive order quietly rewired the rules of money itself. Silver was no longer treated as a commodity, it was pulled into national security law, and that contradiction matters to you, because when an asset becomes strategic, here's the risk most people miss. If prices on your screen no longer reflect physical reality, then contracts, ETFs, and even bank promises can be changed without your consent. According to the sequence of events, billions in banking value vanished without a crash, without headlines, without panic. That's not stability, that's concealment. But here's the part nobody is saying out loud. This wasn't designed to save the system, it was designed to bypass it. Because once silver was reclassified, audits moved from regulators to the military. Paper ceilings broke, and a market that depended on belief suddenly had to deliver reality. So ask yourself this: if silver moved first, what's already moving next? What happened next looks isolated if you only glance at it. But if you slow it down, a pattern starts to form. The executive order wasn't announced with urgency. There was no emergency address, no market halt, just a legal reclassification that quietly stripped silver of its old role and reassigned it a new one. Officially, it was about security. Unofficially, it changed who controls supply, who sets prices, and who absorbs losses when reality collides with paper promises. This didn't come out of nowhere. For decades, silver traded like an afterthought, priced through leverage-heavy paper contracts that almost never required delivery. That system only works as long as no one asks for the metal at scale. The moment that assumption breaks, the entire structure becomes fragile. Now notice what's missing from the early coverage. There was no reassurance about inventories, no clear statement about delivery guarantees, no explanation of how existing contracts would be honored under the new rules, and that raises a question most people aren't asking yet. If this was just a technical change, why does it only move in one direction? Because this isn't about a single metal. It's about what happens when a market built on delay is forced into immediacy. The first hard claim is this: the system wasn't strained. It was structurally short, something it could never deliver. According to the internal breakdown, a small cluster of global banks was carrying an enormous short position in silver, not as a hedge, not as a temporary trade, as a permanent structure, hundreds of millions of ounces promised into the market, while only a fraction of that metal physically existed in registered vaults. That gap wasn't hidden, it was normalized. Here's the concrete detail that changes the picture. Registered inventories were measured in the tens of millions of ounces, while outstanding short exposure was more than 10 times that amount. In plain terms, there were far more claims than metal. The system functioned only because delivery was rarely demanded. Now notice what's missing: no buffer, no contingency, no plan for mass delivery. The model assumed prices could always be controlled with paper and that confidence would substitute for supply. That assumption broke the moment new short positions were cut off. When prices were allowed to move without suppression, losses didn't rise linearly. They exploded. A small price increase became a solvency threat. A large one became existential. But here's where the story flips. This wasn't an accident waiting to happen. It was a risk that only makes sense if someone believed delivery would never be enforced. And now it was. Once delivery mattered, everything accelerated. This wasn't the first time a market relied on paper to control a physical asset. We've seen versions of this before. When leverage replaces supply, stability looks real right up until the moment it isn't. The difference here is speed. Previous squeezes unfolded over months. This one compressed into days. As prices began to detach from their old ranges, what had been considered normal market function started to look abnormal. Exchanges that were designed to facilitate delivery suddenly became places where delivery was discouraged, delayed, or quietly redefined. Rules were adjusted in real time, not to restore balance, but to buy time. And this is where normalization becomes dangerous. Temporary measures became routine. Emergency language became procedural. Cash settlement, once an exception, started to look like the default outcome. The market kept operating, but only by lowering the standard of what a fulfilled contract meant. Now watch how fast this escalates. When confidence depends on belief rather than proof, every adjustment signals weakness, not strength. What should have been unthinkable started to feel inevitable. And the moment inevitability sets in, participants don't wait for confirmation. They rush. The next layer is harder to ignore because the words and the actions no longer line up. Publicly, institutions spoke about orderly markets and temporary disruptions. Privately, delivery obligations were being rewritten. Physical claims were converted into cash settlements, not by choice but by necessity. That distinction matters. When someone pays for metal and receives currency instead, at a price set by a market that no longer reflects scarcity, that's not fulfillment. It's substitution. Here's the concrete shift that changes how you see this. Trading was suspended, contracts were halted, and entire desks stopped offering physical exposure altogether. Not because demand vanished, but because supply couldn't meet it. One major institution after another quietly stepped back, signaling the same thing without saying it directly. They could not deliver. Notice what they didn't deny. No one stood at a podium and said, all claims are fully backed. No inventory numbers were paraded on camera. No vault doors were opened for reassurance. This is where the contradiction becomes permanent. The system continued to quote prices while admitting through its behavior that the asset itself was unavailable. Once that realization sets in, the market is no longer about price discovery, it's about survival. And that's the moment everything you thought was liquid stops being liquid at all. Then the pressure started stacking faster than explanations could keep up. First, trading desks froze. Not officially shut down, just paused, reviewed, or temporarily unavailable. Then margin requirements jumped, forcing participants to post more capital against positions that were already bleeding. At the same time, liquidity thinned to the point where bids existed without offers. Buyers showed up, sellers disappeared. Now layer in the next development. Institutions that once dominated this market stopped making prices altogether. They weren't negotiating, they were retreating. That tells you something important. When a market maker won't make a market, it's not volatility they fear, it's exposure. And then came the speed. Losses that were once theoretical turned immediate. Positions that were meant to be rolled indefinitely were suddenly due. Risk models failed in real time, not because they were miscalculated, but because they were built on assumptions that no longer applied. This is where the system starts to lose control. Not in a dramatic collapse, but in a cascade of small withdrawals, each one rational on its own, but catastrophic together. So ask the uncomfortable question that follows naturally from this sequence. At this point, the story stops being abstract and starts landing in everyday life. Because when markets freeze, the consequences don't stay on trading desks. They move outward. If you rely on electronics, vehicles, energy systems, or anything that depends on stable supply chains, this hits closer than you think. When contracts fail and delivery becomes uncertain, manufacturers don't wait. They stockpile, they overpay, they pull supply forward. That pressure flows downhill. Prices rise not because of speculation, but because availability shrinks. Production schedules slip, costs get passed along quietly, and the people least responsible for the system's design feel the impact first, not as a headline, as a delay, a surcharge, a product that suddenly isn't available. Here's the part that feels familiar to many people. You're told everything is functioning while your experience says otherwise. The system insists it's liquid. Your reality feels tighter, less flexible, more fragile. This isn't ideology. It's lived consequence. When confidence breaks at the top, it expresses itself as friction at the bottom. If this feels familiar, say so in the comments. Because what looks like a market story is starting to look like a pattern. To understand why this keeps happening, you have to step back from the emotion and look at the mechanism. This system wasn't built to deliver metal. It was built to manage perception. Leverage made scarcity look abundant. Paper claims created the illusion of depth. As long as trust stayed intact, the structure held, not because it was strong, but because it was never tested. Here's the unsettling insight. Modern markets reward speed, scale, and confidence, not restraint. The incentive isn't to own the asset, it's to control the narrative around it. Price becomes a signal, not a reflection. And when that signal breaks, institutions don't rush to fix reality. They rush to control fallout. Notice how authority operates in moments like this. Rules don't vanish, they narrow. Flexibility disappears for everyone except the system itself. Losses are contained not by solving the shortage, but by deciding who absorbs it. This is why outrage doesn't change outcomes. The mechanism isn't emotional, it's structural. And once a structure depends on belief rather than delivery, the moment belief cracks, the response is always the same. Contain, delay, redirect. And that tells you something critical about what comes next. From here, the path forward splits, and neither option is clean. One direction is stabilization through control. Markets keep operating, but only on paper. Prices remain visible, contracts remain open, and confidence is managed just enough to prevent a full stop. Physical shortages are handled quietly through cash substitution, priority access, and off-market deals. To most people, it looks like the crisis passed. But underneath, the structure is thinner, more brittle, and far less honest than before. The other path is adjustment through exposure. Delivery keeps getting demanded. Gaps keep getting revealed. Each workaround draws more attention, not less. At that point, prices don't rise because of speculation. They rise because the system is being forced to admit what it can't provide. Here's why uncertainty matters now. Both paths require time, and time is exactly what a delivery-based crisis doesn't allow. Every delay increases pressure. Every workaround invites scrutiny. And every intervention teaches participants how fragile the structure really is. So the real question isn't which path will be chosen. It's whether the choice is still voluntary, because momentum is already forming, and the next move may not come from policymakers at all. There's one insight that ties all of this together. Markets don't collapse when prices move too fast. They collapse when trust stops being transferable. When a promise can't be passed along, hedged, or delayed, it stops functioning as money and starts revealing what it really is: a liability. This entire sequence reframes the story in one sentence. The crisis wasn't caused by silver becoming valuable. It was caused by the system discovering it never actually had it. And that realization doesn't stay contained. Once one asset breaks the illusion, others are questioned. Not immediately, not loudly, but persistently. That's why this isn't an ending. It's a signal, a test of what still works when belief is no longer enough. If you want to understand how this plays out next, how systems adapt when paper meets scarcity, and which signals matter before headlines catch up, follow and subscribe for continued analysis. Because the next shift won't announce itself either.